On the 27th of February this year, the Commonwealth Bank of Australia picked up the phone, called the New South Wales police, and reported itself. The bank had identified in its own loan book approximately $1 billion of home loans it now believed had been originated with fraudulent documents. Some of those documents, and this is the detail the bank's own briefing pack made explicit, had been generated by artificial intelligence. Payslips, bank statements, driver's licenses, income narratives complete enough to pass through a lender's verification system and emerge on the other side as an approved mortgage. The same week, CBA had reported a half-year cash profit of $5.45 billion, the biggest in its history. Within 7 days, Matt Common was on the front page for the other reason. This is the story of how a single former relationship manager, 2 anonymous whistleblowers, a sub-aggregator nobody outside the broker industry had ever heard of, and a chatbot that cost $20 a month, combined to produce the first AI-enabled bank heist in Australian history. And the part the bank does not want quoted in the same paragraph as the rest. There is reason to believe this is the small one. For about 3 years now, every chief executive in Australian banking has been asked the same question on every earnings call. What are you doing about AI? The answers, until February of this year, were comfortable. We are integrating. We are deploying. We are seeing real productivity gains. The answer that nobody on the panel had given until February was the actual one. We are losing money to it faster than we can detect. By the end of this video, you will know how the fraud actually worked, the introducer program, the Penthouse Syndicate, the forensic anomalies that gave the AI documents away. You will hear the timeline of 2 whistleblowers who pressed a button inside an app called SpeakUp in February 2025, 12 full months before the bank picked up the phone to police. You will see what UBS now estimates is the size of the iceberg under the surface. $500 billion of misrepresented Australian mortgage lending. 1 loan in 3. And you will hear what the regulators have started to admit. They cannot catch with the tools they have today. If you would prefer a quieter story about a chocolate factory, this is the moment to leave. We will not chase you down the street. Begin with the count. 1 billion Australian dollars in suspect home loans at CBA, identified by the bank itself, self-reported on the 27th of February. Approximately $300 million in additional alleged fraud, spread across NAB, Westpac, and ANZ, attributed to a single criminal network the New South Wales police call the Penthouse Syndicate. 25 people charged. $95 million in assets restrained. A senior Sydney lawyer added to the list of accused in April. These are the numbers the regulators are working with today. The number that should keep the chief risk officers awake is a different one. In a research note published alongside the CBA disclosure, the investment bank UBS estimated that approximately 1 in 3 Australian home loans currently on bank balance sheets contains false or inflated information. 1 in 3, $500 billion of misrepresented lending sitting on the books of the 4 largest banks in the country. The mortgage broking industry asked the same question, agrees. Equifax, 73% of Australian mortgage brokers reported being targeted by fraud in the 12 months to September 2025. The same number a year earlier was 26. Document forgeries detected across the industry are up 244% year on year. Total scam losses to Australians in 2025, $2.03 billion. What unites these numbers is the curve. 26% of brokers in 2024, 73% in 2025. That is not a trend line. That is a phase change. Something happened in 2024 that made fraud on this kind of document approximately 3 times easier to attempt. What happened in 2024 was that ChatGPT 4 went general availability and a generation of consumer tools followed it. A network is named for where it operates from. The Penthouse Syndicate is named for a luxury apartment in central Sydney, in which, according to the police allegation, a small group of people met regularly in 2024 and 2025 to coordinate the submission of fraudulent home loan applications to Australia's major banks. The alleged operational lead was a man called Andrew W. Hugh, who was, until shortly before the operation began, a relationship manager, first at the National Australia Bank, then at the Commonwealth Bank. He spent the better part of a decade inside the same verification systems he is now alleged to have spent the last 2 years defeating. The mechanics, per the police case, were straightforward and meticulous. Who would source borrowers, some willing, some unwitting, and direct multiple licensed mortgage brokers to submit applications on their behalf. Each application would arrive at a bank with the supporting documents already prepared: payslips, employer letters, tax statements, bank statements. The documents were forged. The brokers, per the prosecution, were paid up to $100,000 per successful loan. Per the prosecution, rotated brokers between applications to defeat pattern detection systems. The same broker submitting 6 fraudulent loans in a quarter would have been flagged. 6 different brokers submitting 1 each, sourced from the same backroom, were not. The first major hit, per police, was on NABI. Approximately $150 million in fraudulent loans, taken before anyone at the bank had assembled the pattern. By the time NAB realized, the syndicate had moved on. CBA was next. The Penthouse Syndicate's alleged exposure to Commonwealth Bank, which is separate from, though related to, the broader $1 billion self-report, climbed past $100 million. Hu was arrested in December 2025. He was charged with 89 fraud-related offenses. Within 24 hours, a sub-aggregator called High Money, operating under license from the larger aggregator Fincher, with around 200 brokers under its own banner, conducted an internal audit and dismissed 14 brokers. Fincher terminated the High Money contract entirely. By April 2026, the New South Wales Police had charged 25 people. The New South Wales Crime Commission had restrained $95 million in assets. A senior Sydney lawyer was added to the list of accused over a separate $25 million in alleged fraud, allegedly run through a legal trust account. The man with the apartment, in the meantime, was on remand, whose previous employers had each, in their respective references, given him glowing performance reviews. It is hard to be sure which line manager has had the worst year about it. A digression about a button. In the years after the 2018 Royal Commission into Misconduct in the banking, superannuation, and financial services industry, a piece of national homework that cost the major banks roughly $10 billion in remediation, fines, and reputational rebuilds, the Commonwealth Bank built an internal whistleblower app called SpeakUp, a small piece of software available on every staff phone with one purpose: to let anyone inside the bank tell the bank anonymously that something was wrong. In February 2025, 2 people, neither of whose names will ever be public if the system is working as designed, pressed that button. The complaint, as later reported by the Australian Financial Review and Information Age, a mortgage broker and a private banker inside CBA's introducer program, were signing off home loan applications backed by fake income statements, allegedly supplied by a small number of accountants. Throughout 2025, more SpeakUp messages followed. The pattern grew. The introducer program, the channel inside which, according to the whistleblowers, the fraud was sitting, has its own backstory. The introducer program is the system by which CBA pays small commissions to outside professionals, accountants, financial planners, bookkeepers, lawyers, for warm referrals to the bank's lending teams. It is cheap origination and it is excellent business when nobody's gaming it. The 2018 Royal Commission named the program as a misconduct vector, and CBA shrank it. The bank did not close it. 8 years later, the same channel reappeared in the same role in a new investigation with the same shape. CBA conducted its own investigation through 2025, quietly without informing regulators, while continuing to write loans in the same channel. Somewhere between October and November 2025, NS Police separately reached out to CBA about the loan book. The Penthouse Syndicate investigation had begun pulling on threads of its own, and several of those threads led back to introducer program loans. The two investigations, internal and external, fused. CBA executives were forced to confront a question they had been delaying since February. Was this misconduct by a small number of brokers, which is bad, or was the bank's own loan book a target of an organized criminal network using AI, which is worse? The answer, eventually, was the worse one. The third decision in this story is the one CBA did not have to make until two strangers pressed a button. Approximately 3 minutes in, and you still don't know what the button looked like. It looked like a button. Forging a payslip in 2019 required Photoshop, a reasonable working knowledge of layer masks, a copy of the right typeface, the original employer's logo at the right resolution, a printer that did not bleed at the edges, a bank statement to match it. The skill ceiling was low enough to commit fraud, and high enough that the fraudsters were a small, identifiable population. Forging a payslip in 2026 requires opening a chat window and typing a prompt. The model produces a payslip from a real employer. Logo, address, ABN, year-to-date figures, tax withheld, super contribution, leave balances. That is internally consistent, mathematically correct, and graphically indistinguishable from the genuine version on a first pass. The same model produces a matching bank statement, with the salary deposit landing on the right Tuesday of the right fortnight, with realistic merchant transaction descriptions in between. The same model produces a matching driver's license, with the right hologram mimic, the right microprint, the right photograph in the right blue background. Not every model can do this. The general-purpose chatbots refuse. The specialized tools, sold quietly on online forums, costing tens to hundreds of dollars per document, do not refuse. CBA's forensic teams, looking back at suspect loans, reportedly identified 3 categories of giveaway. 1. Timestamps that were slightly out of phase. A transaction posted on a Sunday at 3 in the morning, when the genuine bank's settlement cycle does not post on a Sunday at 3 in the morning. 2. Transaction descriptions that were too generic, transfer, deposit, EFTPOS, without the merchant identifiers and reference numbers a real statement carries. 3. Layout symmetries that were too clean. A real bank statement has small printing artifacts, off-grid micro-shifts, the residue of being generated by a real bank. The fakes were too good in exactly the way a generated image is too good. The reason these signals are valuable to the bank is also the reason they are not, on their own, sufficient. Every one of them is fixable in the next version of the model. The bank's defense is in a race with the cost of the attacker's subscription. One of those costs is fixed. The other one is falling. This is what the chief executive of CBA, Matt Common, has not said out loud, but is paying every cybersecurity vendor in the country to help him not have to say. The verification system the Australian mortgage industry runs on. Borrower-supplied documents, inspected by humans with sample-based audit, was designed for a threat model that does not exist anymore. The threat model now is a chat prompt. On the 18th of February 2026, CBA reported a half-year cash profit of $5.45 billion, the largest in the bank's history. Matt Common gave the standard investor briefing. net interest margin, cost-to-income ratio, sustained AI investment, and the share price closed up on the day. 9 days later, on the 27th of February, the same chief executive authorized the bank's self-report to the New South Wales Police and to the Australian Securities and Investments Commission over approximately $1 billion of suspect home loans. The decision to self-report, in legal terms, is not innocent of strategy. Australian corporate law gives a meaningful regulatory discount to the company that arrives in the regulator's office with the file under its arm, before the regulator arrives in the company's office with a warrant. The 2018 Royal Commission, in its operational legacy, had taught CBA a lesson the other three banks had also paid for. The cost of being found by AUSTRAC is approximately 10 times the cost of finding yourself first. ASIC Commissioner Kate O'Rourke confirmed within 72 hours that the regulator was, in her exact phrasing, at the point of making compliance inquiries with respect to those issues. AUSTRAC, the anti-money laundering regulator, was briefed in parallel. CBA executives internally began describing the matter as primarily a money laundering case rather than a credit risk case. The framing matters. A credit risk case is a bank that lent badly. A money laundering case is a bank that was used. The first version invites enforcement action. The second invites cooperation. Within 2 weeks of the disclosure, Westpac and ANZ separately confirmed they had each contacted New South Wales Police about possible related fraud. The Penthouse Syndicate investigation, which had begun as a NAB matter, was now a 4-bank matter. The introducer program at CBA, which had survived the Royal Commission, survived multiple internal reviews, and survived 2025, was, on the 3rd of March, partially closed. Eligible referral leads going forward were restricted to existing Commonwealth Bank customers who had held an active facility with the bank for at least 6 months. Translated out of the press release, the program is now functionally a retention tool, not an acquisition tool, and the channel that was being gamed has been narrowed to a corridor. The final piece of the disclosure was the part that got the smallest headlines and is, on closer inspection, the largest. CBA stated that some of the documents involved in the suspect loans had been generated by artificial intelligence. No major Australian bank had previously, in a public statement, admitted that AI had been the instrument of a fraud against its own balance sheet. The acknowledgement is a technical milestone in Australian banking and almost certainly a regulatory one. APRA has not yet released its position. It is hard to be sure when it will. A summary of the 4 numbers everyone in Australian banking has. This April, written on a whiteboard. $1 billion. The suspect's CBA loans, self-reported. $300 million. The Penthouse Syndicate exposure across the Big Four. $2.03 billion. The total Australian scam losses for 2025. $500 billion. The UBS estimate of misrepresented Australian mortgage lending. 4 numbers, 1 ratio. If UBS is right, and the methodology in their note is, in the broker industry, considered conservative, then the publicly reported fraud is roughly 0.2% of the actual exposure. What we are looking at in the CBA self-report is not the iceberg. It is the corner of the iceberg the bank tripped over by accident. The structural reason is older than AI. The Australian residential mortgage-backed securities market, which the Reserve Bank periodically refers to as one of the safest mortgage markets in the world, has a verification design that depends on borrower-supplied documents passing through bank-employed reviewers, with ASIC overseeing sample audits. The model worked because forging a bank statement was hard. The model is now in a race against the cost of a chat subscription. APRA, the prudential regulator, has been quietly briefing the major banks on a coming guidance, which is the bureaucratic word for a rule change that is not yet a rule, that will require document-level verification against third-party data sources. The Australian Taxation Office's pre-filled data, superstream contribution histories, real-time wage data from employer payroll providers. The same tools every bank already uses inside its own onboarding to check who you are, now to be applied end-to-end to who you say you earn. The cost of compliance with that guidance, if and when it lands, will be enormous. The cost of not complying on the evidence of the last 6 months is by definition larger. The deeper question, the one regulators in private will answer differently to regulators in public, is whether the major banks have the technical capacity to win the verification race at all against an attacker whose costs fall every quarter. The current consensus among Australian cybersecurity and AML professionals is, broadly, not without help and not in the next year, and not without the kind of cross-bank data-sharing infrastructure that competition law currently makes difficult. What CBA self-reported in February is the first of these. It is approximately certain not to be the largest. 3 observations briefly. 1. The fraud is real. The numbers are not exaggerated. The CBA self-report is the first AI-attributed bank fraud disclosure in Australian history, and the size of the iceberg under it on UBS's own working is roughly 500 times larger. 2. The system worked in the narrow sense that 2 anonymous people pressed a button inside an app, and a chief executive eventually had to pick up the phone. The system did not work in the wider sense that it took 12 months between the button and the phone, and during those 12 months, CBA continued to write loans in the same channel. 3. The verification model that Australian retail banking runs on was built for a threat that does not exist anymore. The threat now is a $20 a month subscription. The bank's defense is in a race with the cost of that subscription. One of those costs is fixed. The other one is not. If the next 12 months turn out the way the people inside the 4 banks privately expect them to, the news cycle on this is barely starting. The Penthouse Syndicate is one network. There will be others. There already are. If this is the kind of breakdown you want more of, about the things quietly reshaping money work and the companies you have or have not heard of, subscribe. Next episode, a Melbourne logistics company you have never heard of that moves more freight than Australia Post. We have not forgotten. Thank you for watching.